Markets rarely collapse because of bad news. Bad news is usually obvious. The real damage happens when something important is happening quietly, and most people haven't noticed yet. Think about the last time you checked a chart during a sudden drop. Red candles everywhere. Comment sections filled with panic. The instinct is simple. Something fell fast, so it must be broken. But financial markets don't work that neatly. Prices move first. Understanding arrives later. And sometimes the price drop isn't telling you the whole story. Right now, many investors are looking at the recent movement in XRP and seeing only the surface. A sharp decline, heavy volatility, headlines about technical issues. That reaction is understandable. But markets often create their biggest opportunities in moments that look uncomfortable at first glance. Not because everything is fine, but because the signal is buried underneath the noise. So instead of starting with predictions or price targets, let's slow the situation down. What actually happened? What changed? What data is real? And what is simply interpretation layered on top of it? Once we separate those two things, the picture tends to look very different. And that difference is usually where the real insight begins. Let's start with what can actually be verified. In early 2026, XRP experienced a sharp market correction. Over roughly 4 weeks, the asset declined by about 45% from its recent local high. The drop unfolded quickly, with several large downward sessions clustered within a relatively short time frame. Volatility increased across the broader crypto market during the same period, but XRP's movement was notably steeper than many large-cap digital assets. Around February 19, 2026, developers identified a technical issue related to the signature validation logic within the XRP ledger ecosystem. The problem involved a flaw in how certain transaction signatures could be interpreted under specific conditions. According to developer updates and community reports, the network itself remained operational during the event. A patch addressing the issue was deployed shortly after the vulnerability became known. Network activity continued while the fix was implemented, and the ledger did not experience a prolonged halt in transaction processing. During the same window of time, several on-chain metrics began moving in a different direction than the price. Data from public blockchain explorers indicated that daily transaction activity on the XRP ledger increased compared with levels recorded several weeks earlier. In other words, usage on the network did not fall in proportion to the market price decline. At the same time, large wallet holdings, accounts controlling substantial XRP balances, showed signs of gradual accumulation, according to publicly available wallet distribution data. Smaller retail-sized addresses, however, appeared to reduce holdings during the same period. Outside the network itself, regulatory developments continued progressing. The European Union's Markets and Crypto Assets Regulation, MICAA, is moving through its implementation phases, and the UK Financial Conduct Authority, FCA, has also been advancing regulatory frameworks for digital asset platforms and exchanges. These changes are part of a broader global effort to bring crypto markets under clearer regulatory oversight. Those are the main observable events. Price moved quickly. A technical vulnerability was reported and patched. Network activity remained active, and regulatory frameworks in major financial jurisdictions continued to develop. No conclusions yet, just the facts. Price movements tend to capture attention first. But price alone rarely explains what is actually changing beneath the surface of a financial system. The more useful question is not simply what moved, but what mechanisms were set in motion when it moved. Start with the obvious first-order effect. A rapid price decline, like the roughly 45% correction seen in XRP, immediately changes market behavior. Traders who entered recently may face margin pressure or risk limits. Short-term participants often reduce exposure quickly when volatility increases. Liquidity thins out. Bid-ask spreads widen. That part is mechanical. But the second-order effects are usually more important. When an asset corrects sharply, ownership often begins to redistribute. Smaller retail participants, who typically operate with shorter time horizons or tighter capital constraints, tend to reduce exposure first. Larger accounts, entities that can absorb volatility more comfortably, sometimes begin accumulating during those periods. This pattern has appeared repeatedly across multiple asset classes, not only in digital assets, but also in equities and commodities. Another layer involves how technical events affect confidence. The signature validation issue reported in February 2026 did not halt the XRP ledger's operations, but it still served as a reminder that complex distributed systems require continuous maintenance and oversight. For institutional participants evaluating infrastructure, incidents like this become part of the long-term reliability assessment. In other words, the market does not simply react to the presence of a bug. It evaluates how the system responds to it. Speed of detection, speed of patching, transparency from developers. Those elements contribute to how market participants judge the durability of the network. A third factor sits outside the technology itself: regulation. Frameworks such as the European Union's MiCA regulation and evolving FCA rules in the United Kingdom are gradually defining how digital assets can be listed, traded, and custodied within regulated financial systems. These rules will affect exchange operations, disclosure standards, and compliance requirements for crypto platforms operating in those jurisdictions. Regulatory clarity tends to produce mixed short-term reactions. Some assets face higher compliance costs. Others gain legitimacy as institutional investors become more comfortable participating in regulated markets. Finally, there is the structural role of blockchain networks themselves. The XRP ledger has historically been positioned as infrastructure for cross-border payment settlement and other financial messaging functions. If that use case expands, as some institutional adoption forecasts suggest, then price movements alone may not fully represent the evolving role of the network. But that distinction takes time to evaluate. Markets react in hours. Infrastructure adoption unfolds over years. So the real significance of a correction like this is not simply the percentage decline. It is how ownership shifts, how technology responds to stress, and how regulatory frameworks continue to evolve around the asset. Those dynamics tend to shape the next phase of the market far more than a single chart pattern. Financial markets have a long memory, but it's rarely a perfect one. When investors see a sharp correction like the recent decline in XRP, the instinct is to search for a previous moment that looks familiar. Charts from 2017 and 2021 often come up in those comparisons, since both years marked major expansion phases for the broader cryptocurrency market. In late 2017, XRP experienced one of its most dramatic price increases. Liquidity surged across the entire crypto sector, retail participation exploded, and speculative capital flowed rapidly into large-cap tokens. The rally was followed by an equally sharp correction in early 2018 as liquidity tightened and enthusiasm faded. Then came another cycle. During 2020 and 2021, digital assets again saw a significant rise in market participation. Institutional investors began entering the space more visibly. Decentralized finance expanded, and the broader narrative around blockchain technology matured. XRP participated in that environment as well, although the asset also faced legal uncertainty related to regulatory scrutiny in the United States during that period. In both cycles, price movement followed a similar pattern. Rapid expansion, followed by a steep correction, followed by long periods of consolidation. However, focusing only on the price path can be misleading. What matters more is what the ecosystem looked like before those outcomes occurred. In 2017, the crypto market was still largely experimental. Infrastructure for institutional custody, compliance frameworks, and regulated exchanges were still developing. Liquidity was thinner, and market participants were overwhelmingly retail investors. By 2021, the landscape had already begun to change. Institutional trading desks were participating more actively. Large financial institutions started exploring blockchain-based settlement systems. Governments and regulators also became more engaged in defining rules for digital asset markets. Today, the environment is different again. Global regulatory frameworks are advancing. For example, the European Union's MiCA regulation is being implemented to provide standardized rules for crypto assets within EU member states. In parallel, financial institutions continue to explore tokenization and blockchain settlement technology for various asset classes. These developments do not guarantee any particular market outcome. History rarely repeats itself in identical form, but it does provide a useful reference point. Previous cycles show that sharp corrections have occurred during periods when the underlying infrastructure was still evolving. They also show that market structure tends to change gradually as adoption expands. The purpose of looking backward is not to predict what happens next. It is simply to reduce emotional bias and remind us that volatility has always been part of emerging financial technologies. At this point, the goal is not to predict a single outcome. Professional analysis rarely works that way. Instead, it helps to outline several possible paths and think in probabilities rather than absolutes. Markets respond to changing conditions, and the direction often depends on variables that evolve over time. So it is more useful to ask a different kind of question. If certain things happen, what might follow? Let's look at three broad scenarios. Bull case, conditions strengthen. In a constructive scenario, several conditions would need to align. First, the technical reliability of the XRP ledger would need to remain stable after the February vulnerability was addressed. Markets tend to regain confidence gradually when systems demonstrate resilience over time. Second, institutional interest in blockchain-based settlement infrastructure would likely need to continue expanding. Forecasts from organizations such as Boston Consulting Group and Citi suggest that tokenized real-world assets could reach trillions of dollars in value by 2030. That forecast does not guarantee adoption of any specific network, but it does indicate growing institutional attention toward blockchain infrastructure. If payment networks, financial institutions, or tokenization platforms increasingly experiment with blockchain settlement layers, assets associated with those networks may receive greater attention from investors. Under that type of environment, price strength could emerge gradually as liquidity and participation expand. But again, that outcome depends on adoption actually materializing. Base case, stabilization. A more neutral scenario is often the most common outcome in financial markets. In this case, the market absorbs the recent correction, volatility slowly declines, and the asset enters a longer consolidation phase. Prices move sideways within a range while investors evaluate new data. Several conditions might support this type of stabilization. Regulatory frameworks, such as MiCA in the European Union and evolving FCA guidance in the United Kingdom, may create clearer operating rules for exchanges and crypto platforms. Greater regulatory clarity sometimes reduces uncertainty for institutional participants, even if it also introduces compliance costs. At the same time, broader macroeconomic conditions, interest rates, liquidity cycles, and global risk appetite will likely continue influencing digital asset markets. If those factors remain relatively stable, markets often move into a period of slower, range-bound activity before the next major trend develops. This kind of outcome rarely feels dramatic, but historically it has been one of the more common phases following sharp corrections. Bear case, structural weakness. The third scenario involves conditions deteriorating further. Several factors could contribute to that. If additional technical vulnerabilities were discovered within the ecosystem, market confidence could weaken again. Infrastructure reliability is particularly important for blockchain networks that aim to support financial transactions at scale. Another variable involves regulatory developments. If major jurisdictions were to implement rules that restrict exchange listings or limit liquidity access for certain assets, trading activity could decline. Finally, macroeconomic conditions also play a role. If global financial markets enter a period of tighter liquidity, for example through higher interest rates or declining risk appetite, speculative capital across digital assets could contract. In that environment, prices might remain under pressure until broader conditions stabilize. The purpose of outlining these scenarios is not to claim that any one of them will occur. It is simply to acknowledge that markets move through multiple possible paths. Investors who think probabilistically tend to make more balanced decisions than those who assume a single predetermined outcome. At this stage, the most useful thing isn't another prediction. It's knowing what to monitor. Markets tend to move when several indicators begin shifting together. Watching those signals often provides better guidance than reacting to headlines or social media sentiment. One of the first indicators worth following is the US dollar index, DXY. Digital assets have historically shown sensitivity to global liquidity conditions. When the dollar strengthens significantly, risk assets, including cryptocurrencies, sometimes experience pressure as global capital becomes more defensive. When the dollar weakens, liquidity conditions tend to loosen, which can support risk-taking across multiple markets. Another important signal is U.S. Treasury yields. particularly longer duration yields, such as the 10-year Treasury rate. Higher yields generally indicate tighter financial conditions and stronger competition from traditional fixed income assets. When yields rise quickly, capital often rotates toward lower risk instruments. When yields stabilize or decline, investors sometimes become more willing to allocate funds toward higher volatility assets like equities and digital currencies. Inflation data also matters. Reports such as CPI, Consumer Price Index, and PCE, Personal Consumption Expenditures, influence how central banks adjust interest rate policy. If inflation remains elevated, monetary authorities may maintain tighter policy for longer. If inflation moderates, financial conditions may gradually ease. Inside the crypto market itself, liquidity and positioning metrics provide additional insight. Trading volume can reveal whether price movements are supported by genuine participation or simply thin order books. Open interest in derivatives markets can indicate how aggressively traders are positioning themselves in either direction. Finally, on-chain data offers a different perspective. Changes in wallet distribution, transaction activity, and network usage sometimes reveal shifts in participation before they appear in price charts. None of these indicators provide certainty, but together they help build a clearer picture of the environment in which the market is operating. Watching the process, rather than reacting to individual price movements, often leads to better decisions over time. So after all of that, the real takeaway is fairly simple. Markets move faster than an understanding. A sharp decline can look dramatic in the moment, but price alone rarely tells the entire story. Technology continues evolving, regulations continue developing, and liquidity conditions continue shifting. Those forces tend to shape outcomes over time far more than a single week of volatility. For investors, the discipline is not in reacting quickly. It's in observing carefully. Risk management matters more than predictions. Position sizing matters more than confidence. Sometimes the best decision is to act. Other times it's simply to wait and gather more information. Either way, clarity tends to come from patience. This isn't investment advice. It's simply how I'm reading the market right now, based on the information currently available.